welcome to another episode of interest.co.nz's Of Interest podcast. I'm Gareth Vaughan. In this episode, I'm joined by BNZ interest rate strategist Nick Smyth. Nick's here to talk about what's going on in financial markets and why. Welcome to the Of Interest podcast, Nick. The big event this week, of course, was a meeting of the US Federal Reserve's Federal Open Market Committee. With the Fed being the big kahuna of the central banking world, markets follow it very, very closely. And with a 75 basis points increase to the federal funds rate, which is their equivalent of our official cash rate, to a target range of 2.25% to 2.50%, the news wasn't insignificant. So Nick, how have markets, across the board, equities, bonds and currencies reacted to the Fed?
Thanks, Gareth. And look, before I get started on that, I've got to get the boring stuff out of the way first. So just to say, these are my personal views. They're not necessarily the views of BNZ or anyone else. They're for information only and are not to be taken as financial advice. So, yeah, look, like you said, the Fed raised rates 75 basis points this week. That's a big hike. So, typically in previous years, central banks have moved in 25 basis point increments. You'd have to go back 20 years to find the last time a major central bank increased rates by 50 basis points. You'd have to go back almost 30 years to find an instance where the Fed raised rates 75 basis points. And they've done so again for the second successive meeting. So this is a big move, it's a decisive move. And it's worth, just to put this kind of whole meeting in context, they're now at 2.5%. They're at the same level they reached at the peak of the last cycle in 2018. Now, to give you some context, it took 3 years from beginning that cycle to the end of that cycle in late 2018. It's taken 5 months this time. So they have gone really hard, and they've gone hard partly because they've been too late, and inflation is just the predominant concern. Now, you go 75 basis points is a big hike. The natural reaction to that would be interest rates higher. Actually, it's gone the other way. So actually, bond rates have gone lower. They went lower immediately after the meeting. They've gone lower again overnight after US GDP data printed negative, which we can talk about later if you'd like. We've seen equities go quite sharply higher. And again, that's not normally what you kind of expect to see. We've seen the US dollar, at least the initial reaction, weaken. So those are the kind of things you'd associate actually when a central bank is doing less with interest rates rather than more. And so why is that? Well, firstly, markets are forward-looking. So markets reflect not just the current cash rate, which, it should be said that 75 basis point move was fully anticipated, but they reflect expectations of what that cash rate will be in months and years ahead. And on that, the Fed chair said a couple of things that the markets paid attention to. The first thing he alluded to was that the previous forecast they had made was still broadly reasonable. So, and those previous forecasts had 100 basis points of hikes by the end of the year over 3 meetings. And then he said at some point it would be appropriate to slow the pace of rate hikes because 75 is still a really aggressive pace. Now, the market there were lots of other caveats. He said, well, look, we're going to look at things meeting by meeting. Look, we could do the same again next month. We could even do more next month. But the market took the message that they might slow the pace of rate hikes, and that gave kind of some comfort. So that's led to this repricing lower in US bond yields. It's led to the weakening in the US dollar, or some weakening in the US dollar. It's led to a rebound in equity markets. It should also be said, like in the context of, if you look at the past 12 months, like a reversal of recent trends. So, the trend over the past 12 months has been a massive increase in interest rates, wholesale, longer-term interest rates around the world. And we're seeing a kind of a correction now. We've seen a big increase in the US dollar that's reached 20-year highs on a broad basis. And we've seen, equity markets like the S&P 500, which is like the, kind of like the benchmark really for the US. And that's, that fell more than 20% from its peak So, we've had a rebound, but, from what have been some really big moves.
Yeah, look, it's been very, very interesting watching what's been going on in recent times. One of the things that really caught my eye this week was markets starting to think that central banks might actually be cutting interest rates maybe as soon as next year. Is this all tied in? I mean, you mentioned the US GDP. That was negative for the second quarter in a row, so negative growth or no growth. Is this all because people are now thinking that, I guess, all this interest rate hiking by central banks is going to slow down inflation, possibly tip their economies into recession, and therefore central banks are going to need to be cutting again?
I think that's the kind of essentially the logical interpretation of how you would read market pricing now. So I guess, for listeners' context, the market, let's use the US as like the baseline. The market's got circa 90 basis points of rate hikes over the remaining 3 meetings of this year. So still got the Fed kind of hiking quite aggressively over the remainder of this year. And then next year, it's pricing, just over 50 basis points of rate cuts, with the first rate cut fully priced by June. So, why is that? I think, the logical way to interpret would be to say markets are worried about recession risk. I guess you can kind of see evidence of that in various parts of the financial markets. So for instance, I mentioned before that S&P 500 was down more than 20%. That's that definition of a bear market. Bear markets are, often, but let's be clear, not always, kind of associated with the recession. The US yield curve is inverted, which historically has been quite a reliable leading indicator of recession. We've got, industrial commodity prices like copper, and copper's kind of used in lots of different things. Historically, that's been quite a good barometer of like the strength of global demand, and that's fallen, it certainly had fallen more than 30% from its peak. So you've got like these kind of number of asset classes that are suggesting that they're kind of behaving in a way which they normally would, and maybe in the lead up to or around recessions. And this is taking place in the context of central banks really aggressively lifting interest rates over a short period of time, and in quite a synchronised manner. So, if we X out China, which has got its own issues kind of around zero COVID and so forth, we X out Japan, which is, different story, still battling low inflation. We look at everyone else, like even Europe's raising rates, and they haven't done so for 10 years. So a synchronised global tightening cycle will certainly slow growth. And then we've got, these other kind of contributing factors probably that are giving markets concern about the rising risk of recession, including, like I mentioned, China's kind of the risk of lockdowns and restrictions in China, and, the situation in Europe where you've got potential, gas shortages and power rationing later this year. So, I think asset markets are kind of telling you that recession, there's at least a reasonable, if not a high chance of recession next year. And historically, during recession, the Fed cuts interest rates.
Absolutely. And what are we looking at now in terms of, I guess, the high point of this cycle in terms of the Fed funds rate and the Reserve Bank's official cash rate here in New Zealand? I mean, the RBNZ, for example, I think in their last monetary policy statement, were forecasting around about 4% peak in middle of next year.
Yeah.
They're now at 2.5%, same as the Fed.
Yeah.
The market's picking the RBNZ to be cutting next year as well, and what peaks are we looking at in terms of market pricing at the moment? Yeah,
look, the first thing I'd say is it's kind of constantly in a state of flux because markets are so dynamic, but they're always dynamic, but especially now they're incredibly volatile. And, so before I jump onto exactly what's priced, the context here, right, is you've got, like we mentioned before, you've got, markets seeing a significant risk of global recession, and that's the situation historically where central banks would cut rates and bond rates would be lower. But at the same time, you've got inflation that's its highest level in decades. And that would ordinarily kind of pull up on on both interest rate expectations and bond rates. So, and the market really has swung between these two concerns. Back in the middle of June, we went, and let's use New Zealand here for a start. We went to a point there where the market was thinking the peak in the official cash rate might be above 4.75%. And at that time, the official cash rate was 2%. So that's, a big gap. And, in the US, we had the market thinking that, the peak in the federal funds rate could be 4% or above. And now the market's kind of switched concern to, hang on, like recessions might be coming, and we've had a big recalibration. So, in the US, it's kind of now expected to peak about, let's call it, somewhere between 3.25%, 3.5%, with, just over 2 rate cuts next year. In New Zealand, the peak now is somewhere between 3.75% and 4%. And the New Zealand market now is reflecting that same profile as what the US is. So there are some rate cuts, albeit not as much as in the US, that are priced into the short end of our curve as well. I mean, it should be, I guess maybe just a couple more things on that. So the first would be, if we look at the US, you've got the market for inflation. So we can actually kind of say, well, okay, what does the market think is going to happen to inflation? Is the pricing of interest rate cuts in the US logical, internally consistent with what is being priced for inflation? And if you look there, we've got a headline inflation year on year at just above 9% on a CPI basis at the moment, which is staggeringly high. At the end of the year, the markets think it'll be kind of around 7.5%. So it will have peaked and it will be on the way down. At the end of 2023, the market thinks it might be around 2.7%. So that is a really big fall. And again, that kind of would be consistent with the market thinking you've had a big recession, or there will be some kind of miracle around global supply chains and so forth. So the market is pricing these rate cuts in the US, you kind of say, partly, at least on the basis that it expects this really significant moderation in inflation to come about. And, the verdict very much is kind of still out on whether, that inflation profile will match the market's expectations or whether it actually might prove more persistent and sticky. And that's the kind of scenario, I think, where maybe the Fed might be slower to cut rates than what it might have done historically. But the market always has, certainly the interest market always has this habit of looking at kind of the major markets and especially the US and going, this is what I think, the market investors go, this is what I think is going to happen with the Fed. And then they have this habit of kind of superimposing that profile onto other central banks, unless they have a very good reason not to. With regards to, New Zealand, you mentioned, peak in the OCR, the Reserve Bank's projections have it at, let's call it 4%. And the Reserve Bank's own projections from May, the Reserve Bank actually did have some rate cuts, or at least had the profile of some rate cuts towards the latter part of their forecast horizon. More so, it should be said, in 2024 than 2023. But the logic there being, they take the cash rate above quote unquote neutral and into restrictive territory, and if that is sufficient to get inflation back to levels where they're comfortable with, then that would be the kind of situation where interest rates or the OCR might normalise back towards kind of more neutral levels. But, the Reserve Bank's projections, they update them every 3 months, and there have been some big changes over the past 12 months to those.
They sure have. I'm also keen to have a chat about what's known as quantitative tightening. Now, we've heard a lot about quantitative easing, or QE, over the past couple of years. Obviously, in a New Zealand context, that's because we've seen the Reserve Bank, or we saw the Reserve Bank in 2020 embark on QE, or quantitative easing, for the first time, which saw it buy about $54 billion worth of government and local government bonds off banks in the secondary market, with the aim of lowering borrowing costs to households and businesses by injecting money into the economy. Now, the Reserve Bank here has started selling about $5 billion worth of these bonds annually to Treasury. This won't have any market impact, will it?
Look, it should have some market impact. The question is really, we kind of know direction. We don't know magnitude. So, I mean, I guess for context, the Reserve Bank, when they bought that 54 billion of bonds, they did it in a very kind of front-loaded fashion because they wanted to have an impact in lowering interest rates because at that point, the official cash rate was 0.25%. They didn't think they could take it lower operationally. They wanted to add stimulus. Government bond issuance was going up a lot, and this seemed like the right tool. Their judgment was this seemed like the right tool for the job. So they bought that, 54 billion in a little over 12 months. Let's call it 15 months. Now, on the way out, it's going to be a kind of a far slower process. So they're going to sell, or the plan is they will sell 5 billion of bonds per year, not in the secondary market, I might add, but back to New Zealand debt management, back to Treasury. And they made this announcement earlier this year. And so New Zealand debt management, the Treasury, needs to finance those bonds it's buying back. So that's an extra 5 billion of bond issuance that it will need to complete. So when the budget came out in May, they lifted their forecast bond issuance, and the main reason for that was because they had to account for these repurchases. So the information is out there, like it's in the market. So to the extent markets are kind of forward-looking, they should have already kind of incorporated this in. What it means is, relative to a situation where the Reserve Bank didn't sell its bonds, or probably more specifically, if it continued to maintain the same level of bond holdings by reinvesting its bonds, this kind of QT, where they sell the bonds back or let them mature, private sector investors will need to kind of essentially take their place, and that will mean kind of more, kind of essentially greater supply of bonds, and all else equal, that would put some upward pressure on interest rates, mainly longer term kind of bond rates. Now, I think, empirical, if you look at, New Zealand doesn't have much experience with QE, let alone kind of QT, but you can look at kind of other markets and what's happened when they've done both QE and the Federal Reserve when they did QT. And I think, my observation would be there are lots of factors that affect longer term interest rate, and the main ones are macroeconomic in nature, whether the economy is doing well, what inflation is expected to be, what the central bank is expected to do with its cash rate, and these supply and demand forces, at least historically, certainly haven't been a major driver. They've been a second order or a third order kind of driver. And that would be my expectation here, given the pace of it isn't nowhere near as huge as kind of what it is on the way in. And I think that's essentially the Reserve Bank's desire. They accumulated these bonds. They decided, you've kind of got to this point where, markets are functioning. They're certainly not in crisis like they were when they intervened. Tightening monetary policy. They're not easing monetary policy. In a perfect world, they probably wouldn't have a big, portfolio of government bonds on their balance sheet. This isn't kind of like the judgment, I guess, isn't a bad time to start gradually kind of reducing our holdings. If you don't do it now, when would you do it?
Onto the Fed. I mean, obviously the Fed is undertaking this quantitative tightening, which, opposite of quantitative easing, moving to decrease the amount of liquidity or money supply in the economy. Now, this is on a much, much, much bigger scale than the Reserve Bank of New Zealand, isn't it? So what sort of impact is this going to have on the market? And are there any particular parts of the market or markets per se where this will be felt?
I mean, I guess I'd start by saying we still don't have a huge amount of experience with QT. So, the only central bank really, and the RBNZ is just starting, but the only real experience we've got with QT was the Fed itself in between 2017 and 2019. So we can kind of draw on that as an experience. But since then, the Fed has added even more tools in its toolkits to try to kind of manage markets. If we look back at that 2017 to 19 experience, you would think again, kind of essentially using the same logic as I just outlined before for New Zealand, but there should have been some kind of upward pressure on longer term US interest rates because market needed to buy more bonds essentially. And we kind of did see higher longer term interest rates over that time, but I think that's essentially mainly because at the same time as the Federal Reserve was doing its QT, they were also raising their cash rate. And actually, if you look at the yield curve, which I guess we could talk about later, that kind of flattened through this period, and that, if it was all about supply demand factors, that probably should have, if anything, steepened. That kind of illustrates there are lots of other factors, maybe more important than QT for the long end of the bond market. The other kind of, way through which QT works, and in the US they're doing it slightly differently to New Zealand. So they're actually not selling bonds actively they're not selling bonds like the RBNZ is. They wait till the bonds mature, and then they will not reinvest those holdings. Now, the RBNZ's kind of doing that as well, but for the RBNZ, there's so much fewer bonds, they'd have to wait until April 2023 for the first, and then another year for the second. That the Reserve Bank of New Zealand's doing these sales as well. But for the Federal Reserve, you've got hundreds of Treasury bonds. They mature, pretty much every month, so multiple times a month. So they're constantly kind of rolling off, and they've set these limits on how much they'll allow to kind of roll off per month. As private sector investors go to take the place of the Fed, when Treasury refinances those bond maturities and the Fed doesn't reinvest, a private sector investor buys it, that will also reduce the amount of I think in markets they call liquidity within the banking system, the balances that the banks hold at the Federal Reserve. And, in 2017 to 19, eventually it got to the point where banks didn't necessarily want to let go of any more of their kind of cash balances. They didn't really want to lend them out. And then we had these pressures in short-term US funding markets, and that essentially kind of brought a halt to this kind of the Fed's kind of QT the first time around. So, this time around they're doing it. Well, they've got a lot more bonds, so they've got something like $8.5 trillion, and they've added something like $4.5 trillion since COVID. So they're going faster at reducing the size this time, but there's still a lot of liquidity in the banking system. So my guess is, there'll be a crunch point at some time, but still it's going to be some time away before you might get to the point where banks don't actually want to kind of lend out their kind of remaining balances. I should say as well, QE, seems to kind of have this magical impact on the stock market. A lot of commentators talk about it. It seems to almost have this kind of mythical, when they're adding liquidity, when they're printing money, commentators will say, well, that's, this is kind of behind, this rally in the stock market. These same people will be worried, like liquidity is going the other way. I'm kind of not so sure about that. I guess, it's definitely a factor which affects broader market sentiment, and market sentiment matters. Investors can get kind of worried and cautious, and that makes them, less keen to buy risk assets like equities, or they can become, exuberant and really keen to buy risk assets. And I guess kind of QE or QT is one of those factors that can affect the psychology of markets. But, again, if we look at 2017 to 19, equity markets, they were choppy, but, from start to end, they were higher. So, again, kind of other factors going on kind of during that time.
Absolutely. You mentioned the yield curve and also earlier in one of your earlier answers. Let's have a bit of a chat about that, just to explain what we mean by a yield curve. The yield curve is a line that plots yields or interest rates of bonds with equal credit quality but differing maturity dates. The slope of the yield curve gives an idea of future interest rate changes in economic activity. Now, there are three main yield curve shapes: the normal, which has an upward sloping curve, inverted with a downward sloping curve, and flat. So what shape have we got at the moment, Nick, and what is this telling us?
Yeah, so, you're absolutely right, Gareth. I guess the first thing I'd say is there are not only that, but I guess when investors or markets talk about yield curves, they're typically talking about two distinct points. So they're comparing two distinct points along that maturity spectrum, comparing the interest rates and saying, well, is it upward sloping, flat, or downward sloping? And depending on which 2 points you take, you can get different answers. I guess for context, and this has got quite a bit of attention recently because in the US, the yield curve between the 2-year and 10-year government bond maturities, which is a really standard kind of measure of the yield curve, that has become inverted. So that's, last I checked, at least around minus 20 basis points, which is its most inverted it's been since 2000, if I'm not mistaken. Now, what is that telling us? Well, I guess, you think about, what are the interest rates at various points in the yield curve? What are they telling us? Well, the shorter term interest rates are more a function of, what the central bank's doing immediately and expected to do in the, kind of near term. Longer term interest rates are more about, I guess, the full interest rate cycle, expectations of interest rates in the longer run, expectations of those neutral interest rates, where they'll eventually maybe normalise back to. And that's driven a lot by market expectations of growth and inflation. So if we think about, let's say this US 2-year, 10-year or 2s, 10s yield curve now, what it's telling us is the market expects the Fed to be hiking pretty aggressively in the near term, and then it expects kind of rate cuts to take place thereafter and rates to normalise at some kind of lower level, consistent with the Fed taking rates above neutral and then needing to kind of go the other way. Now, I guess this is interesting because historically, like I mentioned earlier, the yield curve's been actually one of the kind of few really kind of reliable leading indicators of US recession. So, and I guess recessions don't come around all that often. So you've only got, a sample size of, that's not hundreds, right? But certainly in the US, since the mid-1970s, the 2-year, 10-year yield curve has inverted before all those recessions, with a lag of 12 months or longer normally. And I think that's kind of because the market expects cuts, and often rate cuts are kind of happen certainly in the US when we have recession. Now, people look at the 2-year, 10-year yield curve and they go, well, okay, like what other stuff's going on? Like, it could be different this time. And I guess, it's kind of most of the time the yield curve inverts, and the Federal Reserve or kind of people often, certainly in the past, might go, well, this time's different. Back when it inverted in the 2000 and whenever it was, 6 or 7, people were saying, well, look, China's buying lots and lots of US bonds, and that's artificially keeping interest rates low, the inflation expectations. But I think when you look at it this time and you say, okay, well, it's inverted, it's historically been reliable, you look at the signals from other asset classes and you go, well, actually, they're kind of telling you a similar story, which is, at face value, a major growth slowdown. I think it kind of corroborates that's probably where the markets see things going. Might not be right, but I think that's kind of what the market expectation looks like now.
Just to wrap up, Nick, let's look ahead to next Wednesday, and we have Statistics New Zealand's Household Labour Force survey coming out. Now, a lot of us look at the headline unemployment number when we see that, and last couple of quarters it's been 3.2%. I know a lot of economists are picking it to be even lower this time. What are you guys expecting? And also, what will financial markets be looking for in the household labour force survey?
Yeah, so, I guess for context, like the unemployment rate's 3.2, it's at record lows. You look at any kind of labour market indicator and it is really, really tight as a barrel at the moment. So, we're expecting the unemployment rate actually to nudge down. So that would be a fresh record low. So, we've penciled in 3.1 for the unemployment rate, but leading indicators, the risks around that, probably if anything, it might even be even lower, notwithstanding the data can sometimes be quite volatile. So, there's lots of things within the labour market report. You've got unemployment rate, which kind of gives a measure of capacity. You've got employment growth, where we're expecting kind of modest positive employment growth, but obviously in an environment where there's not much migration, and participation's really high. So it's not like the labour supply is really expanding at all at the moment. And then there's wages. And wage growth, and there are kind of various wage measures as well. So there are a few things kind of the market will look at. I guess when the market reacts, or when the market thinks about it, the market thinks in kind of two dimensions. First is, what are all the economists like BNZ and other banks kind of expecting? There'll be some kind of consensus, and I don't even think that's come out yet, frankly. And then they'll be thinking like, what's the Reserve Bank got? So when the Reserve Bank sits down in August at its meeting and it refreshes and throws in all the new economic data, turns the handle on its model, what would that imply for the interest rate track? So that's another kind of, I guess, benchmark for the market to compare it to. In this instance, the Reserve Bank has got, it's the same as us on the unemployment rate, I think 3.1%. So, something like that at face value probably wouldn't be a huge reaction. I think the question is, for the Reserve Bank's projections, is they're expecting the unemployment rate to be going up, maybe even from later this year. And that's kind of the question, is whether the tightness in the labour market will resolve that quickly or whether it actually might take somewhat longer. For the market, you can often have like a big reaction on the day, but there's lots of other stuff going on too, and kind of especially as the global picture is really changing kind of quite rapidly, certainly in the eyes of investors. And that's been, I think when you step back and look at it, look at what wholesale interest rates in New Zealand have done over the past 6 to 8 weeks, it's really been mainly about the market's interpretation of global events. So we had a CPI release, in New Zealand like last week, that was really strong. Certainly on the kind of non-tradable side, but the market quickly switched attention to a reserve meeting and GDP in the US overnight, and that's kind of overtaken the domestic developments.
Great, Nick. Look, thanks a lot for that, Nick. That's Nick Smyth, who is BNZ's interest rate strategist, and I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.